Alright, let's break down how interest works in savings accounts, making it super clear and easy to understand. Imagine you have a piggy bank, but instead of just holding your money, it magically makes it grow. That's kind of what a savings account does with interest. When you deposit money into a savings account, the bank pays you a small percentage of that money as interest. This interest is usually calculated daily and paid out monthly, helping your savings grow over time. The more you save, the more interest you earn, making your money work for you. What is interest? Interest is essentially a reward you get for letting the bank use your money. When you deposit money into a savings account, the bank uses that money for things like lending to other people or businesses. For example, they might give out loans to people buying homes or starting businesses. The bank earns interest from these loans, which is higher than what they pay you. In return, they pay you a little extra, which is the interest. Interest is calculated based on the amount you deposit and the interest rate, which is a percentage of your deposit. Some accounts offer compound interest, where the interest you earn also earns interest over time. Key vocabulary: interest rate. This is the percentage the bank pays you on your savings. When you deposit money into a savings account, the bank uses that money to lend to others. In return, they pay you a small percentage as a reward for letting them use your money. This percentage is known as the interest rate. Think of it as the growth rate of your money. The higher the interest rate, the faster your savings will grow. It's like planting a seed and watching it turn into a tree over time. The more favorable the conditions, the faster and healthier the tree grows. Similarly, a higher interest rate means your money will grow more quickly. For example, a 2% interest rate means the bank will add 2% of your balance to your account over a year. If you have $1,000 in your savings account, a 2% interest rate means you'll earn $20 in interest over the course of a year. This might not seem like much, but over time it can add up significantly, especially if you continue to save and the interest compounds. Earn. This means to gain or receive interest. When you earn interest, it's like getting a bonus for keeping your money in the bank. The more you save, the more interest you can earn. It's a way to make your money work for you, even when you're not actively doing anything with it. You earn interest on your savings. Every month or year, depending on the terms of your account, the bank will calculate the interest you've earned and add it to your balance. This is a great way to grow your savings without any extra effort on your part. Grow. This refers to your money increasing over time due to the interest earned. As you continue to save and earn interest, your balance will grow. This growth can help you reach your financial goals, whether it's saving for a big purchase, building an emergency fund, or planning for retirement. Compound. This is where the magic happens. Compound interest is one of the most powerful concepts in finance. It's the process of earning interest on both your initial deposit and the interest that has already been added to your account. This can lead to exponential growth of your savings over time. Compound interest means you earn interest not only on your initial deposit but also on the interest you've already earned. For example, if you have $1,000 in your account and earn $20 in interest, the next year, you'll earn interest on $1,020. This cycle continues, and over time, the amount of interest you earn can grow significantly. It's like a snowball effect, where your savings grow faster and faster as time goes on. Annual percentage yield, APY. This is a more accurate measure of the interest you earn on your savings because it takes into account the effect of compounding. APY shows you the real rate of return on your savings over a year, including the interest on interest. For example, if a savings account offers a 2% interest rate, the APY might be slightly higher, say 2.02%, because it includes the effect of compounding. Always look at the APY to understand the true earning potential of your savings. Principal. This is the original amount of money you deposit into your savings account. The interest you earn is calculated based on this principal amount. For instance, if you deposit $1,000, that $1,000 is your principal. Over time, as you earn interest, your principal grows. If you keep adding to your principal, your savings will grow even faster due to the compounding effect. Financial goals. These are the objectives you set for your savings. Whether it's buying a house, going on a vacation, or building an emergency fund, having clear financial goals can help you stay motivated and disciplined in your saving habits. Setting financial goals gives you a clear target to aim for. It helps you plan how much you need to save and how long it will take to reach your goals. This can make the process of saving more rewarding and purposeful. Percentages explained. Let's say you deposit $100 into a savings account. This is a common scenario for many people who want to save money and earn some interest over time. Understanding how percentages work in this context can help you make better financial decisions. Imagine your savings account offers a 2% annual interest rate. This means that for every $100 you deposit, you will earn 2% of that amount as interest over the course of a year. To calculate this, you multiply $100 by 2%, which gives you $2. So after 1 year, your account balance will grow from $100 to $102. This might not seem like a lot, but it's a simple example to illustrate how percentages work. Now let's take it a step further and talk about compound interest, which is where things get more interesting. If the interest compounds annually in the second year, you'll earn interest not just on your initial $100, but also on the $2 you earned in the first year. This means you will earn 2% of $102, which is approximately $2.04. Now your balance will be $104.04. This process of earning interest on both the initial amount and the interest that has already been added to your account is known as compound interest. Over time, compound interest can significantly increase the amount of money in your savings account. The power of compound interest lies in its ability to grow your money exponentially. The longer you leave your money in the account, the more interest you will earn, and the faster your balance will grow. This is why it's often said that compound interest is one of the most powerful concepts in finance. It's also important to note that the interest rate can vary. Some accounts might offer higher interest rates, such as 5% or even 10%. The higher the interest rate, the more money you will earn over time. However, higher interest rates often come with higher risks, so it's important to choose an account that fits your financial goals and risk tolerance. When planning your savings strategy, consider your financial goals. Are you saving for a short-term goal, like a vacation, or a long-term goal, like retirement? Your goals will help determine the best type of savings account and interest rate for you. Regularly reviewing your savings account and the interest rates offered can help you make informed decisions and maximize your earnings. By understanding how percentages and compound interest work, you can take control of your financial future and make your money work for you. Let's break down the percentage calculation further. If you have a different amount, say $200, and the interest rate is 3%, you would multiply 200 by 3%. This gives you $6 as interest for the year. Similarly, for $500 at a 4% interest rate, you would earn $20 in interest annually. These examples show how different amounts and interest rates can affect the interest you earn. By understanding these calculations, you can better plan your savings and choose the best account for your needs. Understanding time. Interest rates are often expressed as an annual percentage rate, or APR. This means the interest is calculated over a 12-month period. Some banks calculate and pay interest monthly. If the annual interest rate is 2%, they might pay 2% divided by 12 each month. This makes the compounding effect work faster. Some accounts even calculate interest daily, which can further enhance the compounding effect. For example, daily compounding will yield more interest over the same period compared to monthly compounding. Understanding how time affects interest rates can help you make better financial decisions, whether you're saving for a short-term goal or a long-term investment. The longer you save, the more your money can grow, thanks to the power of compounding interest. Detailed example. Imagine you put $1,000 into a savings account with a 3% annual interest rate. This means that the bank will pay you 3% of your balance as interest every year. After 1 year, you'll earn $30, which is 3% of $1,000. This interest is calculated based on your initial deposit, also known as the principal amount. In the second year, with simple interest, you would again earn $30, making your total balance $1,060. Simple interest means you earn the same amount each year based on the initial deposit. If the interest compounds, that $30 is added to your balance, making your new balance $1,030. Compounding means that you earn interest not just on your initial deposit, but also on the interest that has been added to your balance. In the second year, with compound interest, you would earn 3% on $1,030, which is $30.90. This makes your new balance $1,060.90. Each year, the interest is calculated on the new balance, leading to exponential growth over time. The more frequently the interest compounds, the more your money will grow. This is the power of compound interest, which can help you build wealth over the long term. Why it matters. Understanding interest is crucial for growing your savings. Even small interest rates can make a big difference over time, especially with the power of compounding. The longer you save, the more your money can grow. For example, if you save $100 a month in a savings account with a 2% interest rate, you'll earn interest on your deposits, which adds up over time. This can help you reach financial goals like a vacation or an emergency fund faster. Understanding how interest works empowers you to make smarter financial decisions. Key takeaway: savings accounts are a great way to grow your money by earning interest. The interest rate indicates how much your money will increase over time. Compounding means you earn interest on both your initial deposit and the interest that accumulates. For example, if you deposit $1,000 at an interest rate of 5%, you'll earn $50 in the first year. Over time, with compounding, your savings can grow significantly. Understanding these concepts helps you make informed decisions and maximize your savings. Gap 2S, common mistakes. While savings accounts are a valuable tool for growing your money, some common mistakes can hinder your progress. First, not comparing interest rates. Banks offer different rates, and not shopping around might mean you're missing out on better returns. Always compare rates before opening an account. Second, ignoring fees. Some savings accounts come with maintenance fees or minimum balance requirements. These can eat into your savings. Look for accounts with low or no fees. Third, withdrawing too often. Frequent withdrawals can reduce the amount of interest you earn and in some cases may incur penalties. Try to keep your savings intact to maximize growth. Fourth, not taking advantage of automatic transfers. Setting up automatic transfers from your checking to your savings account ensures you consistently save without thinking about it. Finally, not understanding the impact of inflation. Your savings should ideally grow at a rate that outpaces inflation. Otherwise, the purchasing power of your money decreases over time. Avoiding these common mistakes will help you make the most out of your savings account and achieve your financial goals more efficiently. Gap 2S. Thanks for watching. Don't forget to like, share, and subscribe for more financial tips and insights. Now that we've covered the basics and common mistakes, let's delve into some advanced concepts related to interest and savings accounts. Understanding these can help you make more informed financial decisions and maximize your returns. First, let's talk about different types of interest rates. Beyond the standard annual percentage yield, APY, you see on savings accounts, there are also variable interest rates which can change over time based on market conditions. While these can offer higher returns, they also come with more risk. Next, consider compound interest versus simple interest. Compound interest means you earn interest on your initial principal, as well as on the accumulated interest from previous periods. This can significantly increase your earnings over time compared to simple interest, which is only calculated on the principal amount. Another advanced concept is the role of high-yield savings accounts. These accounts typically offer higher interest rates compared to traditional savings accounts, but may come with certain restrictions or higher minimum balance requirements. Investment strategies also play a crucial role in growing your savings. Diversifying your investments, such as combining savings accounts with stocks or mutual funds, can help balance risk and return. Additionally, considering tax-advantaged accounts like IRAs or 401(k)s can offer tax benefits that enhance your overall savings strategy. Lastly, understanding the economic factors that influence interest rates, such as inflation and central bank policies, can give you a better grasp of why rates fluctuate and how to time your investments. By mastering these advanced concepts, you can take your financial planning to the next level and ensure that your money is working as hard for you as possible. Thanks for watching. Don't forget to like, share, and subscribe for more financial tips and insights. Now that we've covered advanced concepts, let's explore some real-life applications of understanding interest. These examples will show you how this knowledge can help you make better financial decisions. Imagine you're planning to buy a car. By understanding the difference between simple and compound interest, you can choose a financing option that minimizes your overall cost. For instance, opting for a loan with compound interest might seem appealing at first, but the interest can add up quickly, making the car more expensive in the long run. On the other hand, a loan with simple interest could save you hundreds if not thousands of dollars over the loan's term. Next, consider saving for a down payment on a house. Knowing the benefits of high-yield savings accounts can help you grow your savings faster. While a traditional savings account might offer a modest interest rate, a high-yield account could significantly boost your savings, helping you reach your goal sooner. Understanding interest rates is also crucial when dealing with credit cards. Many people fall into debt traps because they don't realize how quickly interest can accumulate. By choosing a card with a lower interest rate and paying off the balance in full each month, you can avoid costly interest charges and keep more money in your pocket. Investing is another area where knowledge of interest can make a big difference. For example, if you're investing in bonds, knowing how interest rates affect bond prices can help you time your purchases and sales to maximize your returns. Similarly, understanding how compound interest works can guide you in choosing investments that will grow your wealth faster over time. Lastly, consider retirement planning. By contributing to tax-advantaged accounts like IRAs or 401(k)s, you not only benefit from compound interest but also enjoy tax breaks that can enhance your savings. Understanding how these accounts work can help you build a more secure financial future. In summary, mastering the concept of interest can have a profound impact on your financial well-being. Whether you're financing a car, saving for a house, managing credit card debt, investing, or planning for retirement, this knowledge empowers you to make smarter financial decisions. Thanks for watching. Don't forget to like, share, and subscribe for more financial tips and insights.